Hi, I'm Pattu from freefincal, and this week let's take a look at a debt mutual fund for a change. This is ICICI Pro Money Market Fund. This is a short-term bond fund, and you can use it for durations of 1 year and above, or even for very long-term durations. We'll take a look at the type of fund and its portfolio history. So if you look at the scheme mandate, it says the mandate of the fund is to provide reasonable returns commensurate with low risk while providing a high level of liquidity. High level of liquidity means that it is going to invest in bonds of very short duration. The maximum is going to be 12 months, and it will always have some kind of cash holding, short-term bonds, and that's why it's called a money market. Money market is a segment of the bond market where the commodity being traded is actually money. Cash is being given for short-term lending. There are several types of money market instruments. I have a video on this. Have a look at it. And the portfolio duration of this fund can range from 1 day to which is cash to up to 12 months maximum. So that's what it means by high level of liquidity. Low risk means that it will try to invest in short-term bonds, like I said, and short-term bonds generally tend to have low sensitivity to interest rate risk. And in general, money market funds can take on credit risk, but this fund has so far avoided any kind of significant credit risk, as we shall see. And the fund will employ what is known as a buy, hold, and then buy again strategy, or what is known as the accrual strategy. That is, it will not try and sell the bond in the middle of the term to get capital gains. It will buy a bond that now will increase mainly from the interest rate component of the bond, and it not come because of the capital gains, because the fund manager sold or purchased other bonds in the middle of the term. So that will ensure that the fluctuations in the NAV is lower. This is the portfolio maturity of the fund since September 2012. Notice that the blue is bonds up to 12 months. That's the dominant part. The orange is non-maturity units, means cash, and you can see some of the some portions are exceeding 100%. That means it's debt fund arbitrage. So if this much portion is exceeding 100%, then that much portion below 100% will exactly compensate for it and cancel out. So that's called arbitrage. They buy and sell in the same bonds in different markets, the futures market and the cash market and so on. That's why you have that extra component coming inside. This is the asset type history of the fund. The blue is A1, A1 plus or A1 minus. Those are the highest rated short-term bonds. The cash equivalent is shown in orange, little bit here and there. Sovereign is the gray, and others are in yellow. The others are have been absent for at least since the SEBI recategorization. The fund has not even taken that much of risk. Mostly it has stuck to sovereign, cash, and A1 plus kind of bonds. And this is the AUM of the fund in the left axis, and in the right axis you have the expense ratio. The red is the expense ratio for the regular plan, the black is the expense ratio for the direct plan. And you can see that the AUM has after the SEBI recategorization, the AUM of the fund significantly fell down. That's because I think ICICI must have instructed its distributors to or must have contacted its institutional investors, maybe. I think in this regard they must have asked them to shift to something else. Maybe they have shifted to the overnight fund, and being a pretty liquid fund, this fund can handle such large AUM swings. It's not a big problem. The expense ratio has not changed much for the last, at least since the SEBI recategorization, but it can change anytime. And at least I think they're trying to build the AUM up, and then they will increase the expense ratio for higher profits. And this is the annualized return, the trailing annualized return for the last 1, 2, 3, 4, 5, 6, 7 years. It's more or less about 7.5% or so. If you invest in this fund, you should expect a little bit more return than a liquid fund, maybe about 6.5%, 7% before taxes. So should you consider this fund? This fund will be a little more volatile than a liquid fund, assuming there are no credit events. The volatility I'm referring to is the daily fluctuations. So do not use it for less than 1 year, but above 1 year you can use it. So far it has a good credit quality record, but this may change in future, so you have to keep a track on that. You can use it for more than 1 year, any duration above 1 year as part of your portfolio, or for short-term goals, you can use it exclusively if you are comfortable with it. Those who want regular income can also use it for regular income via withdrawals, but you must be careful about the associated risk and you must understand what they are. You can ask, is it worth taking more risk by choosing such funds than why not stick to a liquid fund? The point is, as long as this fund and the liquid fund has got very good credit quality, there's not much of a difference in the terms of day-to-day volatility, and above 1 year it should not make a big difference. And those who want a little bit more return for longer durations can definitely consider funds like this. Franklin Savings Fund is another money market fund which has got a similar profile like this fund. So do have a look at this in detail before investing. Do your own research, and if you have any questions, comments, please leave them below. Bye bye.